Hello everyone, welcome to Analog IAS. Today we are going to discuss about balance of payments. The balance of payments record the transactions in goods, services and assets between residents of a country with the rest of the world for a specified time period, usually 1 year. Until the balance of payments crisis of 1991, India's approach to forex reserves was essentially aimed at maintaining an appropriate import cover. Later, the Rangarajan Committee, formed in 1993, stressed the need to maintain sufficient reserves to meet all external payment obligations and to ensure a reasonable level of confidence in the international community about India's capacity to honor its obligations. The balance of payment consists of two accounts, capital account and current account. Now let us see about capital account. It deals with capital transactions, that is, those transactions which create assets or liabilities. It reflects the net changes in the ownership of national assets. The components of capital account are FDI, FPI, external borrowings and reserve account with the central bank. Coming to the current account, it includes goods, services and income. It also includes current unilateral transfers such as donations, gifts, grants and remittances. You should note that the grants might appear as a component of capital account but are included in the current account as they are unilateral and they create no liability. Recipient does not have to give anything back in return. Next, a country with a rising current account deficit shows that it has become uncompetitive. Also, the current account deficit and fiscal deficit are together known as twin deficits and both often reinforce each other. That is, a high fiscal deficit leads to higher current account deficit and vice versa. Now, let us see the difference between balance of trade and balance of payments. The balance of trade is a part of balance of payments. The balance of trade just includes the balance between export and import of goods. But balance of payment not only adds the services but also adds other components in current account, that is, example transfer payments and capital account, example FDI and loans. Now let us see a question based on this. Which of the following constitute capital account in balance of payments? Options are 1. Global depository receipts, 2. International trade credit, 3. Government securities purchased by foreign investors, 4. Securities purchased by FPIs. As we know that any transaction that creates future obligations or liabilities or change in assets and liabilities is come under capital account. So the answer is all of the above. Thank you.